All right, let's get back to the markets. We are looking at a somewhat mixed picture heading into the opening bells. We just did a deep dive on the geopolitical developments overnight, just one of the many factors investors are assessing right now, along with earnings season and these fresh developments on the interest rate story, namely traders getting their heads around the idea that rate cuts in the U.S. no longer seem to be a near-term thing, even though in Canada we're hearing a lot of talk that the Bank of Canada may start cutting rates as soon as June. If we give you a month-to-date scorecard on the stock market against that backdrop, we've got the S&P 500 now down 5 days in a row, putting the April loss at nearly 5%, more significant than the Canadian market's 2% April decline. Really the only difference maker being that our materials and energy stocks have fared better given oil and gold prices, whereas tech has struggled, as have some rate-sensitive stocks. For more on the market mood, let's bring in Rabobank strategist Christian Lawrence. Christian, great as always to have you with us. I went through a laundry list of considerations for investors right now. Is there one at the top of your list?
Thanks for having me, John. It's great to be here. I mean, I think interest rates are absolutely critical, as is volatility. Volatility has really been a key transmission mechanism around the geopolitical noise that we've been seeing. Because believe it or not, just a couple of weeks ago, we were at pre-Russia-Ukraine lows when it comes to energy volatility. We were at a subdued levels with equity volatility, FX volatility close to the lows, and even interest rate volatility was back to pre-hike levels. So we're really at this strange juncture, and I think that is feeding through into a lot of market price action at the moment. But of course, it really is inflation and interest rates that are the key trigger here.
Yeah, and what do you think the general issue on that one is? The fact that, you know, we've had to reassess ultimately what the U.S. central bank is going to do on rate policy this year?
Exactly. I mean, at the beginning of the year, at one point, there was over 100 basis points of cuts being priced into the US and something similar in Canada. And now, if you look at the US, it's less than 50 basis points priced by the end of the year, a little more in Canada at 60 basis points. And I think that pricing is pretty reasonable. We do expect the Bank of Canada to start cutting rates this summer, but for the Fed, we expect them to really wait until September before the first move. And I think the key message here is it's not an aggressive easing cycle. It's more about adjusting rates because the inflation dragon has not been slain. And there's some clear arguments for some more upside when it comes to supply side driven inflation over the coming months.
And that's certainly something to watch when it comes to, let's say, the Canadian dollar. We've been talking recently about how there's still a lot of near-term buzz on rate cuts in Canada, as you alluded to, versus a pushback of that conversation in the U.S. And so the loonie has steadily been losing ground against the U.S. dollar. I guess that wouldn't surprise you.
No, exactly. I mean, I've been seeing 0.74 as a magnet over the last year, but now I think that is really becoming the ceiling for the exchange rate. I don't think we're going to go below 0.715, but that range is likely to remain in place. It is worth noting when it comes to free floating currencies, the Canadian dollar versus the US dollar is actually the lowest volatility exchange rate in the world at the moment. And historically, we tend to see the Canadian dollar being driven by interest rate differentials and oil prices. But that relationship to oil has fundamentally changed over recent years. And now we really need to see a very large, very sharp move in oil for that to really filter through into Canadian dollar strength. So for now, I think it's really going to be all about interest rate differentials. If we assume that the worst case scenarios don't emerge and we don't see oil start jumping up into the three-figure territory.
And then, Christian, let me also ask you just about directionally stock market themes to think about, because you highlighted the volatility story. I mentioned that with the S&P 500 closing lower yesterday after opening higher, that was a trend we saw for 4 days. So that's the longest string of those kind of developments we've seen since 2018. When I look at the overall level of the S&P 500, it's come down, give or take 5% from the highs. The TSX has come down, give or take 3% from its record level. If people are trying to figure out what the next few weeks, the next couple of months looks like directionally, what do you think happens with equities?
That's a great question. Well, I think actually a lot of the pullback we've seen has been driven by the mechanical, systematic type funds, the CTA accounts, if you will, that do react to this spike in volatility. And I think they've essentially been unwinding a lot of their long positions. In Toronto, the stock exchange is really stabilizing around that 50-day moving average at the moment. But I think this is going to be completely dependent on how things develop in the Middle East, because that is being the main driver of the spike in vol that we've seen recently. And of course, that is inherently very difficult to predict. If we assume that things start to calm down again, then volatility is likely to come down. And I think we'll see a bit of a retracement of that recent sell-off. But I think in general, my view on equities this year is more about consolidation rather than strong direction in either way. But volatility really is that key trigger.
And just a final question, people have been fascinated by the movement in gold, and that's one of the factors that has helped the Canadian stock market this year. It seems like whatever the situation of the day, we can find a reason that seems to support bullion in 2024. But I guess if there is this looming uncertainty and all these other considerations in the market right now, what do you think that story is going to look like, the story around something like gold?
Yeah, I tend to be quite bullish of gold at the moment. When you look at the world, we are in a world where debt continues to rise quite dramatically. There is a general debasement of fiat currencies overall. And I think it is prudent to hold an amount of gold in your portfolio. Of course, one of the phenomenons we're seeing now, particularly for younger investors, is treating Bitcoin as a somewhat similar proxy to gold at the moment, a digital gold, if you will. But for me, I do think there's more upside per troy ounce for gold prices heading into the rest of the year.